Hello everybody, welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, so today we're going to talk about the benefits of assuming a loan.
Right.
Okay, so what does this mean, assuming a loan?
Okay, so there's this thing called a qualified assumption, which means that the buyer has to qualify to assume your loan and you are released from the responsibility of that loan. So that loan gets transferred from you to the buyer and you are free and clear. You no longer own that loan, you no longer owe that money.
Let's make this simple. You're buying a house, interest rates are 6%. The house you're going to buy, the person already has a loan on it, and that's a 3% loan. You don't want to go get a new loan and then have your mortgage pay him completely off and then you make payments on 6%. So you go to him and say, hey, you got a 3% loan, let's work a deal. I'll take over your mortgage payment and then I'll give you some cash or I'll get cash from friends or I'll borrow money, whatever. And then you'll just give me your loan and I'll make your mortgage payments. That's an assumption. That's effectively what you're doing.
Right. So the cool thing about that is, like Todd said, you can get money to pay off that seller basically from anywhere you want, because this is not predicated upon you having what's called seasoned money. I call it mattress money. You can use money from any source. Nobody cares. So long as the seller gets their money, they're very happy. Now you do have to qualify to assume that loan. So in order to qualify for that loan, it's just like qualifying for a new loan in that you still have to provide 2 years tax returns, W-2s, bank statements, have good credit, all of that. Now, some of you may remember back in the day there were short sale departments. Well, banks are now creating assumption departments. So that they're trying to streamline this process. So by law, they have 45 days to approve your assumption. So that means that when you make that offer, that escrow period has to be at least 60 days because you need to build some pad as far as inspections and that sort of thing. They've got 45 days to approve you, and then there's still stuff that has to happen after that. So realistically, if you're a seller and you're accepting this offer, kind of think about this taking about 70, 75 days to close.
Okay, so here's a chart we're going to put up. We'll talk about a couple of these. This is something we got online. We did not make this, and we do not necessarily agree with all of these potentially, but they're definitely on here. There's some definite benefits of doing an assumption. So the first one, no new loan origination or funding fees, because you're not creating a new mortgage.
Correct.
And you're not paying those upfront fees to the mortgage.
Absolutely. And then the other cool thing is that you don't have to pay the lender title insurance because that was already done on the front end. Because remember that lender title insurance insures the lender that the property can be sold, and it also ensures their position in line on that deed. But none of that's changing, so you don't have to pay for that.
Interest savings.
Okay, interest savings. So you're obviously paying a whole lot less in interest than the going rate. So
because you're assuming, the idea is you could get a loan for 6. You got a perfect example, and like is the VA loans, military loans. They've got a 3% loan. You want to buy their house that they have a VA loan on. You just go and say, can I assume your loan? He goes, yeah, but I've got $100,000 equity. Okay, perfect. I've got $100,000 in the bank. I'll give you the $100,000. You let me assume the loan. The loan's actually becomes in my name. You're off the loan. Like you don't even.
Okay, so on the VA, we have to make a distinction on VA loans.
Yeah.
So on a VA loan, if you're not a veteran, you can absolutely assume that VA loan. However, that veteran still has that eligibility portion part of the loan
tied up.
Tied up. Okay, so that's an important distinction. However, if you are a veteran with a VA loan and a veteran assumes your loan, then it goes against their eligibility and your eligibility is freed up. So that's the difference. So again, veteran, if you're selling it to a non-veteran, you are dismissed from the loan, but you are missing out on that eligibility.
No appraisal requirement.
Correct.
Because you're not originating a loan for the entire amount of the thing.
Right. So we're going to go through a lot of these, but please keep in mind that each lender has their own rules and each state has their own rules. So we're doing this in a generic fashion. Continue.
You can qualify for a larger sale price with a lower monthly payment.
Right. So again,
than you would if you got a loan at the prevailing rate.
Right. So again, because you're only paying 3% interest, you can afford a greater amount of debt because it's at a lower interest or a lower payment.
You potentially are saving on mortgage insurance if the previous person already is to the point where there is no mortgage insurance anymore.
Right, correct. So that's a good thing.
So basically all the costs of a mortgage are in the first 5 years of it, originating it and then the first part of it. And if you're assuming a loan, this was super popular in the 70s and 80s. Matter of fact, back then, before the internet, people used to just go in the newspaper and there would be a little ad that would say 3-bedroom, 2-bathroom, VA assumption rate, 9.5%. And people go, oh, 9.5%, it's a great rate, assumable VA. And they would even tell you how much money they wanted. I want $8,000. So you would basically knock on their door and say, hey, I see you want to sell your house for, at your rate, what's your payment? And they would say, oh, my payment is $530. And you go, oh, that's great. Okay, so I'll give you $8,000 and then I'll take over your loan. Back then, it was actually super easy because the banks were used to this. So you would basically go to the bank, they would say, oh, okay, you were assuming it. They would swap you guys out. You would give them the money, go to a title company. I mean, you did all this without real estate agents. It was a lot different than now. It's become, there's more fingers in the pie.
Absolutely. So the thing that I really want to stress is make sure that this is a qualified assumption, meaning that the buyer has to qualify for this and that the seller is released from the responsibility, because that obviously is really important so that the seller is no longer on the hook for the loan.
If you're on the hook as the seller, when you go to buy your next house, the first thing you're going to say is, well, you already are making this house payment over there. And if you try to go, oh, well, no, somebody else is making it, they're going to say, we don't care. It's counting against what you can borrow, and you're not, the loan's not, has been removed from your credit score and everything. Right,
so that's what you want to make sure. And the last thing that I want to make sure that you understand is that when that purchase offer is made, there are two numbers. There's a firm number and kind of a floating number. Now that floating number is the amount of the loan. Because remember, I just said that this transaction takes like maybe 70, 75 days, and the whole time the seller is making mortgage payments. By the way, these assumptions can only happen so long as that mortgage is current. So if that seller has stopped making mortgage payments, this is not going to happen. Yep. But so make sure that mortgage payment is definitely going against the balance of the loan, so that amount is floating. So what you want to do is you want to make sure that you're agreeing on that sale price regardless of what that loan balance is, so that everybody is kind of on board with the same thing. It makes a huge difference the amount of money that the buyer has to bring in at closing, right? Because the more the seller pays down the mortgage, the more money the buyer has to bring at closing, because he has to meet that difference between that firm purchase price and whatever that loan payoff is.
Definitely, if you're thinking about doing this as a seller, talk to your agent, talk to the title company, and most importantly, talk to your lender. They do not have to, in all cases, automatically approve. A lot of them, they're going to say, nope, we don't want that. You have to pay it off. Or if you sell it, do on sale clause. VA and FHA are the ones historically that, especially the VA, because it's a veteran loan. If you're thinking of buying with it, they're in most MLSs, ask your agent. Say, can you find me houses with where they'll do an assumption, and there's a field that they can check, and you can ask your agent to pull all the houses where the sellers are doing an assumption, and you can find those.
Most of them are not going to be checked because most agents don't understand how these work.
Yeah.
But if you are a seller, what you can do is you can call your lender, and even if you're not thinking of selling your house, call your lender anyway. It's good information, and they're good at it right now. Call your lender and say, hey, I'm thinking of selling my house and I want an assumption package. They will send it out to you. A lot of them will FedEx it to you. They're getting really good at this. And the assumption package will come in the FedEx or in the regular mail, and it'll be really pretty straightforward. It's usually about 5 to 10 pages. It sounds onerous, but it's not. It gives you the application. It gives you all the information. It's super cool. If you want to know if your mortgage is assumable, kind of an easier way, you can go online and look at your deed. Kind of toward the end of your deed, it says that your mortgage is assumable. If you're not sure, call your title company. They can pull up your deed and they can help you read it. If you want to do this type of transaction, like I said, most agents don't know how to do this. Please have your agent reach out to a title company. Title companies are good at helping agents build these offers properly so that the parties are protected.
All right. Remember, states have different rules. Mortgage companies have different rules. This is not legal advice. This is general information.
Yeah, we just thought it was really cool because it's that kind of market where you can make your home more desirable and maybe even net more money because your home is more attractive than another home that they simply don't know that their loan is assumable. And if you're a buyer and you find a house, ask that seller to speak with their lender about sending an assumption package, because that seller may not know that their loan is assumable. Okay, so if you liked the video, if it was interesting, if you learned something, if we entertained you, please leave us a comment. Please like the video, share the video, subscribe, hit the notification bell, and show us some love. We'll see you on the next video. Bye.
Bye.